This is the Syndicate Room, an AI-generated podcast from AdValorem Syndicate. Everything about this show, the voices, the scripts, the production, is created by artificial intelligence. We believe AI content should always be clearly labeled.
And somehow, we still show up on time. I'm Matilda.
I'm Adam. Today we're doing a three-part sprint. VC mega funds are back. Tender offers as the new "Please Don't Quit" button, and a litigation finance transparency moment that's not subtle.
Haha, the theme is, money is moving, but everyone wants fewer questions asked. Spoiler, they're not getting it.
Quick housekeeping. We publish daily research at gp.advalorem.io. There's an education library on the site, and if you want to meet humans in real life, we do community dinners via an interest list.
And the Discord is discord.gg/gergtp9gts, plus the Substack at advalorem.substack.com. If you want to join the community, it's a simple application at tidycal.com/advalorem/syndicate. Educational community, not investment advice, not an offer, just nerds and PDFs.
All right, topic 1, VC megafunds. The headline vibe is, the biggest shops are raising big again.
Like, big. Not we added a sidecar. More like we bought a small moon.
TechCrunch reported General Catalyst is said to be in talks to raise around $10 billion, Spark around $3 billion, Founders Fund around $6 billion, and A16Z announced $15 billion earlier this year. That's a lot of dry powder showing up at once.
Dry powder is such a polite phrase. It's basically, we are about to reprice your entire cap table. Thank you for your service.
Exactly. And the practical impact is that the fundraising bar becomes weirdly bifurcated. If you're in the AI narrative, rounds can be enormous. If you're not, you're pitching into a vacuum.
I call it the two-lane highway. The left lane is AI with a police escort, and the right lane is everyone else with a flat tire.
There's also a second-order effect. Mega funds tend to like ownership, which can push companies to stay private longer, raise bigger, and postpone IPO pressure.
Which tees up topic 2, the pre-IPO market coping mechanism, tender offers and secondaries.
Yahoo Finance had a piece arguing tender offers are growing, but they're not a replacement for exits. Companies stay private longer, and tender offers become a pressure valve for employees and early holders.
Pressure valve is right. It's like, we can't IPO, but we also can't have everyone rage quitting because their equity is emotional support stock.
And the secondary market lacks the stock market's transparency and rules, so you get information asymmetry. A lot of "trust me, bro" in spreadsheet form.
Haha, a data room is just a fancy way to say, here are 11 PDFs and a KPI definition that changes on page 7.
One thing we've been emphasizing in our quantum pre-IPO analysis and broader research is that private doesn't mean simple. It often means fewer observable prices and more narrative-driven pricing.
And when there's no clean market price, tender offers become storytelling with a term sheet.
Plus, tender offers can be concentrated in a handful of the most desirable names, which means for most private companies, there still isn't a true liquidity path.
So if you're not a top decile rocket ship, the tender offer ferry might not visit. That's a harsh bedtime story.
Now topic 3, litigation finance transparency. Reuters covered a class action involving elite universities where an undisclosed litigation funding arrangement came out during class certification proceedings, creating real risk for the case.
Translation. The judge was like, I'm not mad that you got funding. I'm mad you tried to sneak it past me.
Right. Courts care about conflicts, control, and whether the class is being represented adequately. So disclosure is getting more attention, sometimes via court orders, sometimes via rulemaking debates.
It's the sunlight tax. You can do the thing, but you can't pretend you didn't do the thing.
For listeners, we cover litigation finance as a research vertical, how it works, what disclosure trends mean, and what to watch in case dynamics. This is education, not advice.
And it ties back to VC and secondaries. Everyone wants liquidity, but the minute money gets creative, regulators and judges ask, "Cool, who's really in control here?"
Exactly. Whether it's a tender offer, a structured secondary, or funding a lawsuit, once a third party is economically involved, transparency becomes the price of admission.
Also, transparency is the thing you demand from others, while insisting your own cap table is a state secret.
Ha ha ha! One more quick plug. Our education library includes the new chip warrant case study and accelerator warrant enforcement explainers. Think of it as how warrants behave in the wild, not here's a deal.
Plus, AI robotics research. The robots are coming, analysis that's less Hollywood, more unit economics and supply chain.
All right, takeaways. 1. Mega funds returning means the top of the market can heat up fast, especially in AI. 2. Tender offers help, but don't confuse them with broad liquidity. 3. Litigation finance is in a transparency squeeze, and that pressure is spreading.
If you liked this, go to gp.advalorem.io for daily research and check the Insights page. Join the Discord, read the Substack, and if you want community dinners, get on the interest list.
And if you want to apply to the community, it's tidycal.com/advalorem/syndicate. Again, educational community, no investment solicitation.
We'll be back next episode day, Monday. This has been the Syndicate Room. Remember, this podcast is AI generated, including our voices and script, and it's for educational purposes only.